Welcome to NASDAQ Trade Talks. I'm Jill Malantrino, Global Markets Reporter at NASDAQ. Joining me for this segment is Chris Englebert, Founding Partner and Chief Investment Officer with Englebert Financial Advisers, to discuss why the biggest concern retail clients have now is their retirement assets. And Chris, it's really no surprise considering the action that we've seen in the market for virtually all of 2022.
Yeah, it really accelerated obviously through April, May, and now into June. But one of the things that we're finding, Jill, and we're very excited about a new program that we're starting at Englebert Financial Advisers, is that many times clients, their biggest asset besides their house is their 401k plan. And what would happen is a client would come in and we'd have other assets that we'd be managing for them. And they'd say to us, hey, can you take a look at my 401k? Can you make some changes to it? And in the old days, we could log on, get their username, password. You can't do that anymore. Up until now, when we discovered a fintech company called Pontera. And what Pontera does is it allows us to manage a client's 401k no matter where it's custodied. So, for example, in our own backyard, we have Air Products, one of the largest firms out there. And the probability of Englebert Financial Advisers ever being the Air Products 401k advisor is slim to none. But now what we can do is send a link to a client. They put in their username and password. Then what happens is I have a Pontera dashboard that lights up, lets me see all the funds that they're invested in, all of their options. I can make changes for them. And this is particularly important in what's going on right now, obviously in 2022.
So, Chris, the advantage of this sounds like financial advisors having instant access to client 401ks, 403bs, whatever type of retirement plan it is.
Yeah. This is the biggest thing, I think, since target date funds. So obviously, we all know the history of target date funds. You'd have an advisor on the plan. You can't, what people have to understand is that if you have a 401k, 457, or 403b, the company's not going to manage that for you. The advisor of the plan really can't manage that for you. Well, now RIAs have a solution where in real time, they can actually manage these retirement assets. And it was amazing when we started this program about a month ago. We obviously got a lot of positive reaction. We've seen a lot of people sign up, and I've seen some reoccurring themes. The biggest reoccurring theme is people haven't gotten on and done anything in a long, long time. The second reoccurring theme is people would have a mishmash of funds that they were in, no real rhyme or reason, no focus. And that's what we hope to offer them, is some type of professional management. And what's really neat about it for the RIA is that they can actually take control of their clients' retirement assets. And obviously, it's a revenue stream in the future for the RIA as well.
Right. Chris, are you concerned that clients may overanalyze their portfolio and check in a little bit too much and get out of that longer term investing mindset, particularly in this market?
Yeah, and we've seen this happen over and over again. Markets sell off sharply, people panic. If they haven't pulled up their 401k, 457, or 403b in a while, they pull it up. They're like, oh my gosh, I'm down X% this year. What do I do? The worst thing they can do is stop contributing to it. Now, one of the things that we do in our playbook is that if people are very concerned, hey, the contributions that you're making on a biweekly basis or however you make your contributions, you can always park those in a money market fund inside the 401k, 457, or 403b and reallocate at a later time. But what you really want to do is you got to stay in the game, because what we found is that during severe market declines, some of the best days on the upside come right after a bad day, a bad week, a bad month. And so people, they tend to get out, they never get back in the game.
Yeah, let's take a look at some of the technicals here, starting with the S&P 500.
Yeah, the S&P 500 is literally, we had a low in May. We had a very short, sharp covering rally the end of May to save the month. We then saw a decline because obviously there was some economic surprises, a hot inflation number, the Fed raising rates, and then we did go to new lows for the year. But I say to people, we are trading at emotional levels now. You have analysts, downgrading their targets for the year end. They're concerned about S&P 500 earnings. S&P 500 earnings year over year in the first quarter were up 8%. Second quarter earnings are going to start coming out. And we think that really, one of the things that we try to tell people is that everybody gets bearish at the bottom, and we're seeing our risk indicators at levels that are even worse than March of 2020. So investors have to be very careful here, but we are trading at emotional levels right now.
And Chris, if we take a look at the NASDAQ 100, of course, the relative outperformer when we had the COVID recovery, giving back those gains, and now the relative underperformer.
Yeah, that's been the big story this year. I mean, obviously, if the S&P is down over 20%, you've got the NASDAQ down over 30%. Some of the individual NASDAQ stocks are down 50 to 80 to 90%. And if you look at them, again, extremely oversold levels. Now, whether or not you're a long-term, NASDAQ bull or not, or if you're a long-term NASDAQ bear, one of the things, we have been doing this a long time, and we tell people you got to be very careful about shorting stocks into a hole. So the NASDAQ stocks are down over 30%. Anybody that discovers buying puts or shorting stocks now could be shorting at a time where, you could see a real, again, if this is a bear market, some of the most vicious rallies I've seen on the upside have been during bear markets. You could see that happen literally at any moment, especially in the NASDAQ.
How about the Russell 2000? I mean, valuation has to look attractive at some point.
Yeah, I mean, the Russell 2000 is literally now below its pre-COVID levels. We've been, pounding the table on this one for about 6 months right now. It's very interesting. A lot of other investment houses are beginning to see some of the same things we're seeing from a valuation standpoint. We think that during the next earnings cycle, you're going to see a lot of these small mid-cap companies actually come through. They came through the first quarter with some very good earnings. You're going to see them come through the second quarter with some very good earnings. So there's a huge disconnect between valuations right now in the small mid-cap area and really what's going on out there. And again, this is still our favorite sector moving forward.
And if we take a look at oil here, is the rally over? You're making lower highs here.
Yeah, I've been talking about this for the last 2 or 3 months. We obviously had the high in March. We sold off pretty sharply. It looks like we're making a lower high with oil prices. Again, one of my themes for 2022 is that we have a war premium of $20 to $25 a barrel in oil. And you could see that war premium come out with any resolution, of what's going on with Ukraine right now. A lot of investors, and here's what I'm very concerned about, Jill, are chasing commodity funds right now. In a former lifetime, I used to trade commodities, and I've seen these markets go parabolic, and when they unwind, it's not good. So you have, clients right now, investors going, hey, commodity funds are up 15 to 40% this year. Why don't I buy into that? And I'm like, you got to be very careful, because one of the things that we think is going to happen in the back half of the year is that inflation is going to ease, and it's going to ease because you're going to see lower commodity prices, i.e. energy, and also obviously the agricultural commodities as well.
And finally, Chris, if we take a look at the 10-year here and its reaction to the Fed rate hike this week.
Yeah, I think what's happening now is that bonds are finally providing another alternative. We saw this sharp increase in interest rates. The Fed's driving up. They're doing what they're mandated to do to try and control inflation. And the 10-year Treasury took off. And obviously, this has been the worst start to the bond market ever. But now you're getting an alternative. So what I'm telling clients right now, if you're super scared, move some of the money that's in cash to bank CDs. We're beginning to see bank CDs pay 1.5% to 2%. They're actually going to start paying more than that because obviously the 2-year Treasury is climbing up. But if you're not, if you're really afraid, buy a bank CD. If you're not that afraid, buy some bonds, because again, at this level in the bond market, it's really offering some longer term value. But again, what you should really be doing is making sure your asset allocation between stocks and bonds is correct, because obviously if you're a longer term investor, you're actually looking at the stock market at this particular time. But again, we think bonds are offering a lot of value. What we think is happening is that the Fed is doing their job. They're raising 75 basis points, probably another 75 in July, and they're really trying to get a handle on inflation. And I think that's going to be better longer term for investors.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.